I just want to, I don't know a lot of Jules' background, but I can tell you that I've been working with NREIG for quite a long time. I don't know if you went back and looked, but it's been quite a few years. We haven't done a large volume of properties, but we've done quite a few. And we have several today. But insurance is so critical that it can make or break your deal. Now, is there anybody in this room that doesn't know that insurance has gone up recently?
Yeah.
I mean, it's absolutely ridiculous. You know, it's I'm sure we are. It's kind of like the dock workers' salaries, you know? How much did they get?
62% of what I heard.
Wow.
Man.
They won't like range like that.
And, you know, Michelle used to help save lives. So they didn't get that kind of salary. And they got 2% raises, you know? But anyhow, I'm getting off track. But insurance is very critical. And just thankful that Jules has joined the team as one of our trusted vendors. And you all have, it's on the, if you haven't been on the trusted vendors page, first off, you're going to see all of our vendors on there in a short little video interview of everybody with me and that company. And then on the right-hand side, you're going to see all their contact information. So if you don't get it here, you can go in there and capture all that information there that you need. Just remember, go to the trusted vendors page instead of trying to go search Google and stuff. We want you to utilize the vendors. That's why they're here. Okay. So Jules, if you want to come on up, I'll go pull up your presentation. I did want to say something about roofing though, and before I do that, Lenny just finished a house for me yesterday in North Richland Hills. And just a tip for you in making offers, because we've done this twice now. And that is ask the seller to initiate an insurance claim. Okay, we had the seller, the one in Euless, they initiated the claim and I gave him $3,000 extra. And, you know, we ended up with a new roof and the insurance paid for it. On this house, we were counter offering back and forth on my offer. And I don't remember, but I think we were at 240. He come back, wanted 245. And I came back and I said, I'll do 245, but you initiate the insurance claim. He come back and said, no, I'll keep your 240. I don't want to initiate an insurance claim. What does that kind of tell you? Or he already filed a claim and got the money.
Oh.
One of the two. But so what I'm saying is if you've got a house that needs a roof, don't be afraid to play the insurance card and get that roof initiated. So it's worked twice for me so far. Okay, Jules, if you want to come up front, you can stay there if you'd like to.
So got a bunch of ducks for y'all to take. And I don't know if you saw, but I have a level / measuring tape. It goes up to 10 feet and it's got a little piece of paper thing on there and a pen. It's kind of nice. Throw it in your purse or your guy, throw it in your purse or your, I don't know, your pocket.
European carry-on.
Right. Yep.
Did you say if you're a guy?
You're a guy. Okay. So I will share with you guys a little bit about myself, kind of my credentials. So I bought my first property when I was 18 years old, in 1992. And I bought it for $25,000 in Apple Valley, California. That's where I am from for about 25 years of my life. Before that, Wahoo, Nebraska for 8 when I was a little girl. And then my husband and I moved to San Diego. We spent 15 years in San Diego, and we've now spent 4 years in Kansas City. So I bought that property at 18 years old. I did not come from a family that had money. I had made a decision that I was not gonna have the same life that they had. They were and are amazing, hardworking people, but I wanted more for my kids and myself. And so I decided that this tiny little bit of inheritance that I got, that I was gonna put it into buying my first home. And so I bought it, lived in it for a year, kind of did a house hacking situation, and then after 4 years, I sold it for $175,000. And that's something that you could do back in those days there in California. You could buy something for super cheap like that. Nowadays, one of the reasons we left California is we lived in a Cracker Jack box that was 1.2 million with $1,000 a month for our electricity. So that was a no-go for us. So we got out of there, and now my 8 children, 6 of my 8 children own their own homes. They are investors with my husband and I. They're 22 to 32 years old, and then I adopted my 11 and 13-year-old nieces. And so I have my bachelor's in finance and economics. My master's is in communication and education. And I kind of travel the whole country, and just educating and ensuring that folks understand insurance. I've been in the insurance industry for 30 years. I did construction, restoration, for 25 of those years, working directly with insurance. Individuals, owned a company doing that, as well as working against insurance companies. That's one of the reasons that I got hired by my current company, was because they realized that I would be somebody very good to have come in and tell them everything that was wrong and that we needed to do better on. And so that's pretty much what I've done. And Tim kind of knows there's some things that I've changed within the company when it comes to, if you have a large schedule, they used to send you this Excel file that had like 66,000 questions. Those questions are really important, and we're going to kind of go into that right now. We are doing it a better way, a more efficient way, where we have you answer 10 questions on your property, and then we call you. We just say, do you have any knob and tube? No. Bam. All the way down. That easy. Oh, well, yeah, I think I do on this one property. Fine. No, all the way down, just that one. And so we've gotten it kind of down to a science, to where it's maybe 20 minutes of your time, as opposed to sitting with some big, ugly, disgusting Excel file. I have 30 properties. When I first started there, I told them, I'm not filling that out. So you got a problem, because your EVP of sales and marketing won't even fill it out. So we made some major changes. I have seen a lot of changes in insurance over the time. One of the reasons that I started going out and talking to folks is because I started seeing this thing that I did not like, and that got a little scary. And right now I'm kind of terrified for some folks in Florida and Tennessee and in North Carolina, because I had just been out there and talked to them about this. And, you know, it's something that is very overlooked. It's very misunderstood, and it's very important for you, because it is one of those things that can make it or break it for you as an investor. And what I'm talking about is coinsurance. Does anybody in here know what coinsurance is? No? Okay. So I've been investing for 32 years. Okay. And when I finally realized and understood, it was probably 10, 15 years ago, what coinsurance was, I think we look at it and we think that it's like our coinsurance with our health insurance, where we're like, oh, so if it says 100%, then that means I have 100% coinsurance that the insurance company is going to pay for. That is not what that means when you're dealing with property and casualty. It doesn't matter if you're dealing with an admitted carrier or if you're dealing with a non-admitted carrier, which is also called excess and surplus lines. Okay. So most of the time you can have an admitted carrier, and all that an admitted carrier means is that the state covers their booty if they go insolvent. Okay, that's what that means. So it's just like my favorite thing when they say nonprofit and for-profit, and there's this assumption in our country that if you are nonprofit, that means you don't make a profit. Guess what? That is not what that means. It simply means that it is a version of your taxes. You are a nonprofit, so you don't pay taxes. Okay, so you're fine. So a nonprofit company How many nonprofit hospitals do you know? 1 billion, right? How many nonprofit other industries are there? 1 billion. But every single one of them has to make money, because if you don't make money and you're not profitable, you have to close your doors. Nonprofit is just a tax exemption status. Same thing with admitted and non-admitted carriers. An admitted carrier, and this is where we're going to talk about cost, versus a non-admitted carrier. As a non-admitted carrier, we use all AMA best, A or A plus rated carriers. We have about 15 of them, sometimes 20 that we work with, but we're very particular about who we use, because we're not going to use a company that's shifty or that's going to come in and try and say all of a sudden that they're going to triple their prices. We don't go for that. Now, something that folks don't know is that you have someone called an insurance commissioner. And did you know that your taxes and your taxes can't go up unless your assessor approves it? Your insurance can't go up unless your commissioner approves it. Did you know that? So if you want to know who needs to be fired, let me give you a list. And we start with that insurance commissioner, because this is what happened. In 2019, all of the admitted carriers came in and they put up for what they wanted to do as their increase. Most insurance companies, it's like 3 to 5% a year. And even sometimes it'll go down. Sometimes the prices will go down. Our prices recently, we had a little bit of a down spike on some of them because our carriers trust us and we had done really well. But with these admitted carriers, they have to go to the, commissioner, and they have to get permission. Well, so the commissioners all decided across the United States that they were going to do something called a moratorium, because COVID hit. And so in their genius thought pattern, they thought, we're going to put a moratorium on insurance. So they put a moratorium on the insurance for about 4 years. And then in July of 2023, they decided to approve all 4 years of those requests, all at the same time. Now, did inflation affect that? Of course, because if, the prices for him to do roofing is going to go up, then that's going to affect our insurance. Because believe it or not, if our insurance companies cannot be profitable, not saying they need to be like the diabetic company that was like $7 and then $7,000, should not be like that. But they have to make a profit, because otherwise they're going to do something called pull out of your state. And they're going to say bye. Now, where all these other insurance companies pulled out of Texas, pulled out of California, and pulled out of Florida, NREIG poured into it. So we have $50 million that we've poured into California, $50 million that we've poured into Texas, $50 million in capacity that we've poured into Florida.
Does that mean we get cheaper rates now?
Hopefully, as we fill that capacity, it's that idea of supply and demand, right? And so for us as a company, we are investors that recognized 15 years ago that insurance companies don't know what they're doing when it comes to insuring for investors. So they'll do something silly like, hi, you are an LLC. Well, we don't care that you're an LLC. We're going to put you personally as the named insured. And then we're going to do something even worse, and we're going to put your LLC as the additional insured. The problem with that is, as somebody who dealt with this for 30 plus years, and I've seen every horror story you can think of, is there's something called piercing the corporate veil. So let's say that you have 10 LLCs and you have $1 million in property or $2 million, whatever it is your, criteria, and all those properties. But you have your name as the named insured, and you've got your LLC as the additional insured. If I'm an attorney that is worth half my weight in salt, then guess what's going to happen? I'm going to come in and I'm going to say, I'm going to pierce the corporate veil. We had a slip and fall. We had a kid fall down a hole on your property. And now I'm going to go after you for $1 million, but not just $1 million. I'm going to go after you for $10 million. Well, now I don't just get that liability coverage on that one property because I'm piercing the corporate veil. So I can go after all of your properties. Okay. That's why being insured properly is so important. It's important that a company is not looking to just sell you insurance. You can get insurance anywhere. Okay. Honestly, you can get insurance. That's not the thing. We are advisors, we are investors that are looking for what is in our client's best interest. I had this happen literally 2-3 months ago where a land trust. So this person went to the trouble of getting an LLC. And then as a way to have an invisibility cloak, they did a land trust, right? But guess what the attorney told them to do? Told them to name themselves as the named insured and the land trust as the additional insured. Why? Why would you do that? So now that invisibility cloak is gone. I can see you as a attorney. I'm gonna find out all your other properties. I'm gonna find out everything that there is to find out about you. Where, you know, like Walt Disney, I don't know if you guys know that, but that's how Walt Disney bought all the land that he bought for both Disneyland and Disney World, was through land trusts. Okay? And he did that because he didn't want everybody to know that he was buying up all the land. And he didn't want anybody to know what all he owned. Okay? So it's important that you have a company that actually understands how LLCs, how land trusts, how all of that works, and that can look out for your best interest. So there's two things I'm gonna go back on. So this is an interesting fact. When I was preparing for this, I found out on September 26th, 1958, there was another Hurricane Helene that hit in North Carolina, in the Carolinas, and it was also a Category 4 hurricane. And I thought that was fascinating because, you know, that is a pattern, okay? So when I hear or I see a pattern, that's something that I watch very carefully. So in the insurance industry, what I'm seeing right now is a pattern where these insurance companies are coming to you folks because everyone is concerned because their insurance prices have gone up, right? I understand that. I am in the same boat, okay? But I am in the same boat, and I will tell you, I didn't say this. So I have my bachelor's in finance and economics, master's in communication education. I also am a real estate agent and broker, and I have my insurance agent license, and I've done that for a very, very long time. Okay, almost 32 years. Okay, but one of the things that I watch is when we're in escrow and we're at the closing table, one of the biggest things, somebody said this, that can affect us is the insurance premium, right? Because it affects our debt to income ratio. It can affect our profit margin. It can affect everything. So wouldn't it be nice if you could say, hey, Jules, I'm looking at this property. I'm really interested in it, but I'm also interested in what the insurance on that property is going to cost me ahead of time. You can send us that address through his link. That triggers it. It lets me know, hey, this is somebody important. This is one of Tim's people. And I'm going to get somebody on my team immediately on it. And we're going to get you a proposal ahead of time so that you know how this could or could not affect your debt to income ratio or your profit margin. Okay. So that's something important. But what I started to notice was these insurance companies were coming out of the woodwork. You know, we've been around for a long time. There's a reason why. I'm going to tell you why that is. But so I'm at all these events and I'm listening to no inspection, no underwriting, answer these 10 questions. And I'm like, they're selling snake oil, people. They're selling snake oil, literally. If an insurance company is neither coming out and doing an inspection on your property nor doing underwriting, one of two things is happening. You are either being significantly underinsured, and there is a co-insurance part in there that you don't know about, or you're being overinsured and you're paying too much for your premium. Okay? No ways around it. And I have a couple of examples that I can give you. Liberty Mutual. Everybody knows who Liberty Mutual is, right? Okay. So I got this gal. She's from Boise. She's got some properties in Boise, some properties in Chandler. She's got a couple of properties here. She's got some properties in Columbus, Ohio. She sent me her policy, which I have on my computer, and I'll show you guys if you are interested afterward. And this is an admitted carrier, right? And so there's this assumption always that an admitted carrier, State Farm, Farmers, you know, all these other companies, that they're always going to be looking out for your best interests, that like a good neighbor. They are not there. Just say, okay? Had a tree fall on my house recently. Got $12,000 on a $250,000 claim. Just saying. Working on it still, but it's been 4 months now of arguing with my insurance company that I've had for 25 years. And boy, oh boy, I wasn't late paying them any month. So what I started to notice was there is all of these fly by the seat of their pants, fly by night insurance companies that are coming in, and you don't know that you have co-insurance on your policy. And I would see it over and over. So this gal that has Liberty Mutual, she sends me her policies. So she's insured for whatever her mortgage is. Well, Tim, do you have any equity in any of your homes that is over and above your mortgage? Yeah. And by golly gee willikers, one of them, she had 400,000 on there, but to replace it, now I'm not talking about the land. I'm just talking about what it would cost for her to rebuild it would be $700,000. Okay? She is underinsured by 44%. Co-insurance is a penalty. It is a penalty that happens when you have a loss that goes on before your deductible or your depreciation. I have a guy right now in Florida. Unfortunately, he didn't act fast enough. He has 300 properties out there that were underinsured between 20 and 40% in Tampa. Anybody know what happened in Tampa? Okay. Every single one of his properties were underinsured by 20 to 40%. So what that means is this, let's say he has $100,000 loss. Okay. 40,000 coming off of that, and you cannot recover it. Non-recoverable. So how expensive was that cheap policy? How expensive was that cheap policy that saved you $600 a year? And now he's going to be out that co-insurance penalty, and he's going to be out his deductible, and he's going to be out for who only knows how long on his depreciation until he can turn in his receipts, right, and regain that. But the problem is 40,000 times 300 is what, 1.2 million? That $600 a month for that cheaper policy, was it worth it? No. And this is the other thing, and you brought this up. You are not the end user 99% of the time of what your insurance is costing you. Who is your end user?
Your buyer.
Or your renter. Okay? That's the end user. So when my insurance goes up, guess what else goes up?
Rent.
My rent. Because with supply and demand the way that it is right now, we have a whole lot of folks that bought in, like I bought my house, I'll tell you. I bought it May of 2020 for $305,000. It is 6,000 glorious square feet on a lake, 6 bedrooms, 5 baths, and 2% interest, 1.99% interest rate. Do you think I am ever refinancing, selling, doing anything? Hell no. And most folks that bought, now normally this is what happens, okay? This is like, kind of puts things in perspective when we're wondering what's going on in the market, right? So normally as our equity builds in our homes, people will sell. But when they're building their equity, but their interest rate is 2% and they're looking at 5, 6, 7% interest rates, they're like, what the hell am I gonna, I'm not selling. But this is not a bad thing for us as investors. This is a good thing for us as investors because that means that we have a low amount of supply, which means that we then need to have more rental properties. That brings up our rental property prices. And that means that for us, as the first version of the end user, we can then raise our rental property rates, which I don't know if you guys have noticed, but rental prices have gone up. For us here in Kansas City, I literally could pay for, I'm in a rental property right now, okay? Same exact size as my house, it only took 3 months to get it. Only $10,000 a month. And it's not even in a good neighborhood. I drive a Challenger, bright orange Challenger with a black racing stripe. She is 8 years old and she is a beast and a beauty at the same time. Okay? 4 years, no one touched my car. I moved into this $10,000 a month house and somebody decided to put my car up in the middle of the night and take off 2 of my rims and tires.
Oh, you need those?
Oh, I needed them, yeah. So, just saying, I'm paying $10,000 for my, and I'm gonna just be straight with you. This is not Overland Park, this is not Olathe, this is not a nice area. This is a somewhat decent enough that I can handle it long enough for them to rebuild my house areas, okay? And it's $10,000 a month for this property. Okay, so I want you to remember that when you're dealing with that you do not need to be the end user. The way that it works generally is, right, our taxes and our insurance is part of our mortgage, correct? So what do you charge your renters? You generally charge them what you're paying towards your mortgage most of the time, right? I mean, I do. I'm not, that's the whole reason that I'm here. I'm not here for fancies. I got these 30 properties because I'm building me an empire for these 8 kids and 15 grandkids that I got, okay? And so the idea is that we have to remember twofold, okay? How expensive is cheap? You can send me 100 different policies and I'm gonna look all of them over for you and I'm gonna tell you, this is a good policy and you should not go anywhere. This, you're paying $1,200 a year for nothing. So the one that I'm talking about, that's $1,200 a year, the worst part of all is this is somebody who National REIA recommends, highly recommends. They have an exclusion in that policy that you wouldn't even know. $50,000 is the max that you can get for fire. Let's think about this for a minute. So if I have a fire, I can only get $50,000. On the policy, it states $150,000. It states on there that the replacement cost estimate is $267,000, but there's an exclusion on the policy that if I did not read my policy, I would not know, only $50,000. Now, what does that tell me? That tells me that on top of that, I have this 80% co-insurance or 100% co-insurance. How much am I getting if I have a fire? Well, they're gonna take off probably about $25,000. How much are they gonna take off for depreciation, Lenny? How much do you think? If it's the roof, let's say the roof's 15 years and it's a 30-year roof.
At least 30, 40%.
Okay, so they're gonna get like $5.45. So they've been paying $1,200 a month and they're gonna get $5.45. Now, you guys are my 15th state, I think, in 6 weeks, okay? And the reason that I started going around was because I don't want folks to not know what they're getting themselves into. If that is your appetite for risk, if you're okay with that, then good. But I can't tell you how many people I have gone into. I've been in rooms. Last week, I was in rooms where there were 300, 400, 500 people, including attorneys. When I asked what co-insurance was, no one raised their hand. I had one attorney in one of those rooms raise their hand. Okay? It's something that you have to educate yourself on. We're going to give away 2 of Sean's books today. He has an entire chapter. He's my CEO. He has an entire chapter on co-insurance, and he breaks it down into this like really simple way that you can understand it. So we're going to make sure that we do that. Okay. So I'm going to quickly go through. Yep. I'm going to watch. You're going to be amazed. So you can do 1 to 20 units. Okay. We cover vacant, restoration or rehab, and occupied. You don't have to buy 3 separate policies. We just change the status of your policy. So you can say, I'm doing a VRRR, you know, right? But Jules, I don't want to buy a new policy. I don't want a minimum earned premium. We don't have a minimum earned premium. Why? Because we are investors that insure investors, because we understand that that's a pain point. Okay. This is everything that I can insure. Mobile homes, we can insure as many mobile homes as you want. In a park, no minimum. Vacant land, non-performing notes. Lender placed insurance. There's not one kind of thing. The only thing that's not up here is arbitrage and pad split. And I'm currently working on those because we're seeing a lot of trade stay where folks are doing arbitrage for trades, right? We got a lot of construction going on. Yes, sir.
So on a non-performing note, does that mean like if you got a note from somebody and that was performing at a time and it became non-performing,
Then you would be covered.
I mean, you would make me whole then? Or
I would make
take
you
the
whole,
note?
100%. Yep. You need to send me an address. I'll get you a write-up and send you over what our policy looks like. Okay. So on non-performing notes, those are generally where the ones that my understanding now, I know you're probably way more of an expert than I am, but most non-performing notes is where they're not paying their monthly payment, right?
Right.
So we have that policy specifically to make sure, just like loss of rent. How important is loss of rent if you all of a sudden have your house burned down to the ground? That's gonna be suddenly a very important thing, because that money that you're getting every month, you're not getting it if you don't have loss of rents, okay? So that's important. Vacation rentals, Airbnbs. Another thing is, there's a difference between property and premise liability. We only do our liability one way. We do 1 million, 2 million aggregate on every single property. It's not a blanket umbrella, because that opens you up to risk. It's $7 to $10 a month for 1 million, 2 million aggregate. Find that somewhere else in the country. You won't, because we are investors insuring investors, okay? So property is detached structures, business property is whatever's inside of it. You take your house, you turn it upside down and you shake it, you're gonna lose a refrigerator, you're gonna lose a dishwasher, right? Those are the kinds of things as landlords that are considered to be contents, okay? Unless it is affixed to the home, it is contents. So it's important that you know that. Basic. So I'll have all these old timers that call me, oh, Jules, I just like me some basic and some ACV. I just want some actual cash value and some basic. And I have no problem with that. You know, this one guy, he pays like $33.33 a month. And then I wrecked his world, unfortunately, not on purpose, but I was just doing this. And he was like, well, what do you mean? It doesn't carry water damage and theft? No, baby. Got to read your policy. That is a state version of your insurance form. Okay, that's not just a NREIG made. Okay, this is how the states make it. So on basic, that's what's covered, which is funny. Like, at least out volcanic action, you guys are covered. You're covered. Okay. Vandalism, you're covered. But theft, no, because there's a difference between theft and vandalism, right? So theft, let's say your house is vacant and you're not properly insured on that vacant property that you are rehabbing, and they come in and they pull all your copper wire, and they pull your dishwasher and your new hot water heater, and you know, they decide that your nice brand new air conditioning unit looks really hot to them, they're gonna take it. So weight of snow, ice, or sleet is another one. Okay, so we just want to make sure risk of direct physical loss, all falling objects. I'll tell you what, I appreciate that falling object thing, since it was a falling object that landed on my house and caused $250,000 in damage. If I would have had basic form, would I have been covered for that? No, I would have been out of luck. Okay? Replacement cost versus actual cash value. What is the one difference between those two things? Do you know? Yes, sir. You know. Lenny,
Oh,
You-
replacement cost is they're gonna replace it, what it costs you today, buy it.
Yep.
Actual cash value, they're gonna depreciate your property. If it's 30%, they're gonna hold out 30%, then take your deductible on top of that.
that's
And you
right.
get what's left.
You get what's left.
And it
You
only
do the,
costs
like, you know, like,
maybe $100 a year is difference.
Yep.
And if you just on a roof, for example, I'll just throw this in there.
yep,
For the difference in cost, it'll take you 25 years to make up that difference.
that's right.
And if you
$100 a
don't-
month savings.
Yep,
And if you don't think you're gonna have a hailstorm within the next 25 years, you're joking. You're gonna have that roof replaced, so you're losing. You think you've got this great deal until you have a hailstorm. Then you think,
all of a sudden,
well, I've got to come up with $10,000 instead of
yep.
$10 a month. So what do you want to do, come up with?
And so that the biggest thing is with that replacement cost is it's recoverable depreciation, okay? So like he said, you turn in those receipts, you show them this is what it actually cost. Thank you very much, I will take my check now, okay? So this is just an example, okay? Replacement cost, that's that depreciation. Remember, if we had a $30,000 loss here and we were 40% undershired, we'd be losing another, you know, $12,000 to $15,000, depending on if it's an 80% co-insurance or 100% co-insurance. So you might end up with a big fat zero. That's why reading your insurance policy is so important. Your insurance policy is a bilateral contract. Do you know what that means? A bilateral contract means you have responsibilities to mitigate loss. If there is a tree that falls on your house, you have to cover up the holes, okay? The insurance company also has to make you whole, right? However, you have responsibilities as well. So if you don't have proper coverage, then you're gonna be in trouble. We also do carry flood, earth movement, terrorism, service lines, equipment breakdown, property management, errors and omissions. That means if you are personally doing the property management on your properties for $2 a month, we give you 1 million, 2 million aggregate to cover your losses in case you were to accidentally say something like bachelor pad or no children. You're not allowed to say those things. Or if you were to say something else on accident that went against fair housing. Or you put an ad in the paper, you kicked somebody out before you were supposed to, right? Especially if you live in Portland, because I found out the other day, if somebody decides to come in and they just live there for the rest of their lives, you're not getting them out. And you have to actually pay a moving company to move them and pay them up to $7,000 to move out of your property. So, and then the other thing that we have is a tenant protection plan. Why do we have a tenant protection plan? That kind of sounds like the opposite, right? Tenant protection plan does this, covers your tenants for their contents coverage, but it's in your name. So you are the named insured. They are the additional insured. Why do we care about that? Because then they can't pay for it for a couple of months and then stop paying on it. Number one. Number two, this covers you if Tim decides that all of a sudden that he's mad because I'm kicking him out of the house and he breaks open my walls and defecates in them and tears all my dishwashers and everything out.
People wouldn't do that.
I know. I just had to be funny. But that then, instead of that going against your landlord policy, this is a $60,000 or $100,000, you know, you can choose which one you want, $500 deductible. And it doesn't go against your homeowners, your landlord policy. And it's $7 a month and you can charge it to your tenant. So it protects your tenant, but it also protects you against their negligence. Like one of the kids, we had a kid that shoved a bunch of Legos down into the toilet. And it, you know, there's that line that goes from the street to your house. Well, that line right there, you're responsible for. And it's generally about $15K. And guess how much that coverage is? $15K. Best $500 deductible, $7 a month you ever paid. And by paid, I mean charged your renter.
A bag of concrete down the sewer drain makes a bad day too.
Yep. So these are just some extras, you know, cyber liability. We do commercial. We do higher than 20. We're coming up with up to 40. Then we're going to go up to 120. We're just kind of working on them to get that. But if you have commercial, if you have something out there that I don't have on here, just call me. Because I don't say no until I absolutely know I can't. Right now I have a gal, I have about 5 hotels that we were never able to cover before, and I'm gonna be able to cover them, okay? So just, if you hear no from somebody else, come to me and let's just see what we can do, okay? That's the structuring of your coverage. You guys can ask me like a million different, questions about any of those things, and this is his, your guys's QR code. You can ask me 5 million questions, and I will gladly answer them. And then I don't care how you do it. Usually the way that we do it, usually the way that we do it is, well, how am I going to do a drawing? Nobody here. This is how we're going to do it.
Everybody have business card? Well, yeah, we could just.
Because otherwise I have this that we can pass out. Yeah, you can pass that out. Everybody can, you can either give me a business card or fill that out, and then we can give those away.
Yeah, let me proceed and then we'll do
You
the
are good.
drawing.
And then if anybody has questions, they can just ask.
Was that good or what? Did anybody not learn anything?
Yes, sir.
Then wake up.
You have a vehicle that's supposed to be personal, but we put mileage on it, does that make it automatically commercial?
I mean, that's up to you, honestly.
I mean, as far as the insurance company is concerned,
So how much percentage are you using it for commercial?
about 25% or so.
No, for us, it would be anything over 50%.
There's much difference in rates between commercial and
This guy just went.
I will tell you that I've had homeowners
He
that
is
had
a
a
month
$10,000
member for
homeowner
3 months.
policy, and
Okay.
my
And then
suggestion was
he-
that they talk to an attorney about putting it into an LLC. And this one gal in particular was in Nashville, and we got her property, policy lowered down to 3,600 a year instead of 10,000. So, a lot of the time we can make assumptions. I don't make assumptions anymore in my life. I've learned the hard way that instead of making assumptions, I'd rather just run it and see, you know? So if you're having a hard time with any of that, you can always just shoot me a text. My card that I bought out, did you take my cards? My cards are back there somewhere, and my phone number, you can text me, call me, or email me on that, and I generally answer it right away.
And my concern was, if my existing care, say, got involved in an accident, and I have we buy houses or whatever on the outside of my vehicle, whether to say, okay, that's not a personal vehicle anymore, that's a commercial. because
Yeah,
that
you need
sign
to
you're
read
not
your
covered.
policy, because sometimes what your policies say is occasional use for business purposes is okay. Okay, it's just like with Airbnbs, you'll have some folks that'll add an endorsement on there that says occasional. The problem is, if they do some research and they find out that it's not occasional and it's every day, then you could get denied. So it just kind of depends, and you might want to talk to a commercial. We do mostly fleets when it comes to car insurance. But if you need help finding a good car insurance commercial, I would be more than happy to help you.
I gotta go through the policy, because I just don't wanna,
Tim, did you get anything out of this? There's one thing that he just said. Did you hear what it was? Read your policy.
Oh, yeah. But that's one of those things you want to read at night when you're having trouble going to sleep, right? No, you want to stay awake and read it. I agree. So let's move on. Let's continue the conversation afterwards because we are a bit behind here.